Okay, folks, welcome to our trade review of Blackstone. This is our first earnings trade for the quarter. It won't be the last. It was a very profitable trade. One of our members, Jeff, asked me his exact quote is, can you review the risk on the Blackrock trade at some point? Worst case scenario, etc. I'm new to these. And that's a great question, because what he's thinking about is the path, not the reward. He's looking at his risk versus the outcome. And I really implore people to think more about how do you get to the outcome that you want, which is profitability, with as little risk as possible. So we'll talk about that trade and answer Jeff's question. So how else was our week this week? Well, we did very well. We booked profits on our Tesla short. We have two other trades open. These are our theta decay trades, time decay trades, using options. We're option sellers, meaning we are not the gambler. We are the casino. We finance the trades, and we rely upon time decay to help generate income. And our two trades on NVIDIA and on Salesforce.com are working out very well. But despite the fact that we made some pretty serious gains last week on multiple trades, my favorite trade was Zoom. And I'm going to play for you at the end of this video a clip from the week ahead commentary members. I've already posted it in the members area about Zoom and why it's my favorite trade of the week, despite the fact that we only made $100. And all of our other trades made a lot more than that. But Zoom is my favorite trade by far because of the behavior and not the outcome. So stick around to the end, and I will play that clip for you that I played for members or recorded for members. All right, so let's talk about our earnings season and how we plan on trading this. This is, I posted this on Twitter, and we have already traded Blackrock. You can see here. We will be mapping out certain trades. Goldman Sachs, I couldn't trade because they wouldn't let me out of the Blackrock trade unless I paid some ridiculous amount of money to book profits on that trade, and I wasn't going to do it. So it locked up a lot of my buying power, not enabling me to trade Goldman Sachs, which I wanted to do, but it's okay. There'll be plenty more. We are eyeballing UNH, United Healthcare. That's a trade we'll be involved with. Netflix is certainly a trade we will be involved with. Possibly Schlumberger, IBM, 3M, maybe American Express, and so on and so forth. Qualcomm most certainly will be involved with. And what we'll be looking for are the best risk-reward entry trades. And we're going to talk a little bit about that and what that means in a moment when we review Blackrock. So let's talk about the Blackrock trade. As you're aware, or may not be aware, Blackrock reported earnings on Friday morning. We opened up our trade late Thursday afternoon, and they reported, good numbers, I guess in line with estimates. And I liked Blackrock because of its beta, the level of volatility. So that's what made it attractive to me. Besides the fact that we were getting paid some decent premium on Blackrock, and the margin requirement on Blackrock is at 30%, making it all the more attractive. You're getting premium, you're getting beta, and your margin requirement, the reduction of buying power, is only 30% of the share price. So very attractive. Our strikes were as follows. This is a probability calculator. I would not use a probability calculator for earnings. This is just for illustrative purposes only. We sold the $930 call option. We simultaneously sold the 810 put option expiring on Friday. These options expired worthless, which is good. That's exactly what we wanted. We didn't want the share price to move all that much. So the price was $869.90 when we priced out the trade on Thursday. So you can see we went very, very far out of the money, basically twice the anticipated market maker's move on the trade. So we were quite conservative. We were not greedy. We prepared for the worst and hoped for the best, and we got it. We made a 100% profit on it. And what we were paid on this trade was $2.05 per contract. We traded 10 contracts, so I'll let you do the math there. A very nice profit for a very, very short-term trade. And we didn't have to sit in front of the computer monitoring it. It just expired worthless. And that's what we strive for. So let's talk about the chart and why we placed our strikes where we did. So what we do here at the Contrarian Trader, which is quite different than what a lot of other traders do that trade options, is that you'll see videos that they post on YouTube, but they'll never talk about the technical analysis and the utilization of technical analysis or charts, whatever you want to call it, to help identify the best risk-reward opportunities. Now, were BlackRock at all-time highs, I would have been far more nervous and far more conservative with the trade than what we were, because you have no overhead supply above, no sellers above to help defend the resistance level. But that was not the case. What was clear on this weekly chart of BlackRock was that you had resistance right up here at 933.87 per share. Where do we place our call side strike? At 935, right above those guys. So that if they jacked BlackRock up and into resistance, well, I knew I had sellers of like mind that were helping to beat back BlackRock, or would have been looking to beat back BlackRock, say that 3 times fast, to keep it from testing my call side strike. Now, the put side, same thing here. We knew that there was support below right here at an extreme of $815 per share. And at worst case, $809.91. Where do we place our put side strike? $810 per share. So that way we knew that we had buyers of like mind, those that would step up and bid the shares up higher from that level if BlackRock disappointed. So what was the outcome? Well, despite all the speed bumps that we put in place to avoid a test of our put side or call side strike, the shares, while they closed down on the day on Friday, they came nowhere near to testing our strikes. So it was a pretty simple trade for the most part. The shares traded down a little over 2% on the day. These shares are going to rally. So a good trade on BlackRock. But the question that Jeff had, and I'll bring it back up now, was the what if, right? What if we traded above 935 at the end of business on Friday and our call side strike was tested? Or if the shares gap down and through 810 per contract and our put side got tested, what would we do? What's our worst case scenario? Well, the worst case scenario is that a rule of thumb is that you'll stop out at twice the credit paid. That's a rule of thumb. So we were paid $2.05. If the options ballooned up to $4.10, we would take a loss on that trade. That's one way of trading it, one way of exiting the trade. Another way, which is what I prefer to deem as more reasonable, is that if in fact that our put side got tested, that would have been a heck of a move, a real serious move, probably dropping it down and into the third standard deviation Bollinger Band. And that would probably be an unsustainable downtrend. So what I would do is close out at a loss the current position and roll that trade out. Same strikes. Probably bring the call side strike down if the shares drop down. Not probably, definitely. Probably drop the call side strike down to maybe 925, maybe even lower than that. But we would keep the 810 strike and just roll that out another week or two, giving us more time, allowing the shares to bounce back. And on that bounce back, that'll give us the opportunity to exit the trade at our leisure. So what's the worst case scenario? The worst case scenario is that you continue to roll out this trade and probably go inverted. That would be the worst case scenario, meaning that you've taken such a beating on the put side strike that you need to drop, as you roll out these trades, you need to drop your call side strike below the 810 strike because so much damage has been done. You can't get enough premium at 810 or above that you need to bring that strike down. But you need to be very, very bearish on the stock moving forward. And I really wouldn't encourage that. I have done it in the past. It's really a pain in the neck to manage. I would rather just take the loss, free up capital, live to play another day, rather than struggling with a trade that's just not working out properly and look to make money elsewhere. There's plenty of other opportunities. So to me, that's probably the worst case scenario, that you have to go inverted to manage a trade and you have to roll that trade out in perpetuity. That's locking up a lot of capital, and that's opportunity lost when you need to do that. So that's my take on BlackRock. I hope that answers your question, Jeff. If not, as a member, you have access to me, so ask me anytime in the trading forum. So with that, folks, if you're not currently a member, please consider joining up. Trade with us this earnings season. Watch how we do it. Join our forum. You can see that a bunch of guys, they were involved with the trade. John, Israel, looks like they did well. This is Israel's my first earnings trade. Good for you. Congratulations, Israel. John, hey, I can get used to these. LOL, selling options. Where have you been all my life, Bob? That's the first time I'm reading this. Great job, Bob. Thank you. So join up. Prices are going up for new members. I've been told by my options friends I'm charging a ridiculously low price for this service, and they're talking me into raising rates considerably for the options trades. That does not affect current members ever. I never raise prices on current members. So sign up for the 14-day free trial offer. Get involved right now. Take advantage of it. Cancel at any time. Silver and gold level members get TrendSpider. And with that, I'm going to leave you over the clip that I recorded from members on the week ahead commentary. And it's my favorite trade of the week. It's the trade I made the least on, but it's my favorite trade. And when you listen to it, I think you'll get what I mean. Focus on the phrase, pay attention to the path and not the outcome. Okay? I'll leave you with that as you watch this clip. Everybody enjoy the remainder of your weekend. I'll talk to you on Sunday Night Futures Live. Be well. Value, obviously, the amount of theta decay is going to lose value as well. So this is why we like when NVIDIA does nothing, because this just works in our favor. Whereas if you're an option buyer, this is working against you. Every single day, you're losing this amount of money if the options are doing nothing. So we have 10 contracts. That's $270 and change every single day. That's NVIDIA. I want to take a look at Zoom really quick because I went over one of my less wise decisions of the week, but I think that, despite the fact we had a bunch of profitable trades, we made really good money last week. Those weren't my favorite trades. I think my favorite trade of the week was my $100 profit on Zoom. And why would that be my favorite trade when we made a lot more money on BlackRock or Tesla or even NVIDIA, the time decay on NVIDIA and Salesforce.com? The reason is that remember what our strike was to the put side, 167.50. I didn't like the chart. This is how you integrate charting and technical analysis. A lot of options traders do not do that. We do that here. We saw the shares weakening up. We had a nice bullish reversal bar. This is going to be a counter trend rally. The price action on the 12th told us that. Thank God we got out, because where did it close with our 167.50 strike? 159.72. So I would have had to have rolled out of Zoom into the next week or taking a loss. And the margin requirement, let me validate it. Here, the margin requirement on Zoom, special maintenance, 70%. I would have that eating into my buying power, all because I didn't want to pay attention to what the chart was telling me, that this was a loser trade if I continue to hold it. So this is why we want to always pay attention to the maintenance requirements on these options trades. Because think about it. If you look at the margin requirement, it may seem very elementary that you're using the margin requirement of your brokerage to determine whether or not you should roll a trade or the size of your trade. If you think about it, they've already done the analysis. They know the volatility of the individual stock. Their analysts are saying, hey, we don't want to be too exposed to Zoom. The customer needs to put up a lot more capital because of the volatility. So if they're doing that research for us, why aren't we going to pay attention? They're giving us a gift of their analysis. That's the way I look at it. If they're worried about Zoom, I'm worried about Zoom. So that doesn't mean we won't trade Zoom again. Heck, we're now free to do that at our leisure rather than having fought the chart and ignored the margin requirement. We focused on the path, not the prize. And the outcome was very positive. Think about if I was still short of those puts, I would be underwater by what, about $8? And look at the volume. I think we're going lower here. Let's take a look at a weekly chart. Yeah, we broke support. I think we're coming down here on Zoom to about 139.50. And then we'll look to trade it again. Ideally after earnings, so it's not tying up, well, maybe into earnings. We'll trade it on earnings so we're not sitting with too much buying power being absorbed. But I'll bet you back here, the margin requirement was 40%, maybe 50%. Now it's 70. All right, with that, folks, everybody have a great remainder of your weekend. I'll chat with you on Sunday night. Till then, be well.